It does take us to our talk of the tape today, what all of this means for stocks, which had been searching for new highs within about 2% today before this sell-off obviously has escalated into the final stretch. Dan Greenhaus is with us right now. He's Solus Alternative Asset Management's chief strategist. With me here at Post 9, we see the pictures and we know the story that is unfolding here. How are you thinking about it as a market participant?
Well, to your point, there's two questions here. One is the geopolitics of it, which is obviously an important question to be asking ourselves. And then the second question is, what do I do with it as a market participant? With respect to the latter, it's not as clear cut. And the market's off. We're coming up, we're clearly near the lows of the day, 2%, oil up in the high single-digit percentages. We've seen this before, though, whether it was the drone attack on Aramco at the end of 2019, Soleimani early in 2020, or any of the skirmishes that have arisen in the Middle East over the last couple of years post-COVID. You get these momentary spikes, and then oil comes back down, and we go about our day because oil infrastructure has not been and is not affected. And I think what we have to say today is, at least thus far, we know that oil infrastructure has not been affected. There is The Kark Island has not been hit. That's where basically 90% of Iranian oil finds its way into the Strait of Hormuz, which has not, as we all know, been blocked as of yet. So to the extent that is not touched, then I think this becomes temporary. The issue, obviously, is what happens hereafter.
There are many sort of issues to deal with. UBS today is speaking of this conflict and says it poses the risk of renewed cross-asset volatility. But past incidents suggest that if the conflict remains relatively contained and does not disrupt global energy flows, that the market impact should fade fairly quickly. Now, it is a big if, obviously, on the global energy flow side of the equation. We've been watching the Strait of Hormuz, obviously, to see if there was anything going to happen in terms of a shutdown, which obviously would have more of a dramatic impact on what is already a sharply moving price of oil. But what about this note from UBS? Should none of those things happen that I suggested, that the market impact should fade fairly quickly? Is that how you see it?
I think that's basically what I just articulated. I think the debate is which one of us used fewer words to say meh. And
this feels a little more than meh.
Well, but for equity investors, it always feels like a little more than meh, because the equity market always overreacts to geopolitics. And let's just look at what happened with Liberation Day, where we sold off 20% and eventually came back. And so the volatility in the equity market is always present when these headlines occur, and deservedly so in some respects. I mentioned, and we all know, again, oil infrastructure has not been hit, but that risk exists. To use the Strait of Hormuz, for instance, it's never been blocked. It's miles wide. Their ability to block it, who knows if they even can. Half of it is basically in Omanian waters, we'll go with. It's like the equity market's going to worry about it, but what is the likelihood of that happening, again, considering that it's never happened before?
So what do you think of, I think the move in yields, as we said, is somewhat interesting today. What's your first take on that?
My first thought is that the larger conversation that we've been having on air for some time now about the desirability of the U.S. as an investment destination being called into question in the last couple of months and quarters.
Is this confirmation of that?
I don't know if one day or one moment is confirmation per se, but one would think in a risk-off environment that the U.S. Treasury market would be the traditional safe haven that it has always been.
Along with the dollar, which is acting as it usually does.
Well, it's only fractionally higher.
Gold, which is acting like it usually does.
Right.
It's the Treasury market that's sticking out like a sore thumb today.
Yeah, I don't want to. I tweeted about it earlier, and a couple of people responded to me with some interesting takes on it. I would be hesitant to make a larger argument about it, because that narrative about the desirability of the U.S. is a multi-quarter, at least, if not a multi-year story. So but again, it is unusual, and it's one of those things that bears watching, and we can all ascribe our own personal views into why it's happening on any given day.